Welcome to Montage Services video presentations. And today we're going to talk about International 2, which is Subpart F Income. Before we do so, let's first introduce you to Montage Services. Montage Services is a professional service organization that has offices worldwide: San Francisco, Houston, London, Toronto, and Berlin. And we have tax as well as accounting professionals who are here to help you on questions that you may have. Our area of expertise is international tax as it relates to U.S. matters, and that is what today's topic is about. The topic itself, Subpart F, comes from the name of a section in our tax regulations that relate to outbound taxation. In other words, companies doing business outside the United States. So when U.S. companies set up subsidiaries outside the United States, that income is generally not taxed until there's a dividend made. And because of that rule, many people took advantage of it to put little piggy banks outside the United States and keep their money outside the United States, earning income without ever paying any U.S. tax on it. In John F. Kennedy's presidency, he enacted these provisions that are known as the Subpart F rules, which are considered the anti-deferral rules as they apply to corporations that are set up outside the United States for U.S. owners. As you might imagine, the area where these deemed dividends come up are perceived to be abusive transactions or abusive type of income that's being earned. But in reality, operating businesses need to review these provisions to understand whether or not they've triggered a deemed dividend. Therefore, this area is applicable to any U.S. company that sets up operations outside the United States. So the first type of income that is potentially subject to a deemed dividend is passive income. Passive income is interest, dividends, rents, and royalties. That's fairly clear. But the next two types, which are called foreign-based company income, is not as clear. It is where a foreign company is set up and buys from a related party or sells to a related party in a tax jurisdiction that has a tax rate 90% of the U.S. tax rate. So even places like the UK has a tax rate that's 90% less than 90% of the United States tax rate. But obvious places such as the Cayman Islands or Hong Kong or any location that has a lower tax rate will potentially create this foreign-based sales company income, which would then create deemed dividends back to the U.S. shareholders. The critical exceptions or comments in this area is that the foreign entity has to have earnings and profits. The best way to look at that is cash net profits to have a deemed dividend. You can't have a dividend if you don't have net income. So if the foreign operation is operating at a loss, you don't need to do an analysis whether in a given year it has created a deemed dividend. The other area is income arising from unrelated party transactions does not give rise to that foreign-based sales company income. That's a very important exception. So we have a picture of this where a U.S. company sets up a subsidiary, say in the Cayman Islands or another tax haven, say Hong Kong, and they're buying from an unrelated and selling to an unrelated. So let's say they're buying from a manufacturer that they don't control, and they're selling to a retailer that they don't control being greater than 50%, then that income will not be deemed a dividend back. Two examples in this area, real-life situation and real-life clients of ours. One is a purse manufacturer. They had the purses manufactured in Indonesia. The foreign entity that we set up, a British Virgin Island company, bought those goods and then sold it to retail outlets, stores, Macy's, Sears, Walmart, where the purses were eventually sold to the public. That buying and selling does not create Subpart F income. They were able to generate that income enough so that they could support a marketing team in Italy that then drove their sales to a very large volume, and they eventually got bought out. Another example is a company that does business which does biking trips for families. And those biking services are, in essence, tour operators that take families on tours in jurisdictions outside the United States. So they set up a foreign subsidiary whereby the people go online, they sign up for these trips, and then the trips are obviously done outside the United States. All that income also is tax deferred and does not give rise to Subpart F income. There are also some de minimis exceptions to Subpart F income. If the income is $1 million or less than 5% of the gross income, it will not create Subpart F income. And that becomes particularly important as it relates to interest, because interest income is often earned offshore and it's passive, therefore meeting that definition that we talked about earlier, but it is an exception. The other is what we referred to as the tax rate differential. There has to be a less than 90% of the U.S. tax rate for the company to be considered generating Subpart F income. The final area we wanted to touch on is not in Subpart F, but it is to tax people known as Section 956, and it is a loan. The most common question we get is, hey, my company in this foreign country is making a lot of money. I need that money back in the United States. I know a dividend is going to be taxable, but can I loan the money back? I'm smart, I can loan the money back and it's not a dividend. The government will never know. Well, the government has that covered. They treat that loan as a dividend to the extent of earnings and profits of that foreign company. So loans can be treated as dividends. We've touched on here the basics of outbound taxation, Subpart F. It is a complicated area, and if you have any questions or want to run through a scenario, feel free to reach out to us and we'll make sure to get back to you. Now, does our team here have any questions, the audience?
Yeah, I have a question. Let's say I'm a company and I have deemed dividend. So what information related to deemed dividend needs to be disclosed on my tax return every year?
It's a good question. On either the individual owner's tax return or on the corporate tax return, it does show up as a dividend, ordinary dividend, just like as if the person or the company had received a dividend. If it's an individual, there is no tax credit that comes with that dividend. However, if it's a corporation that's receiving this Subpart F income, it will get what we call a deemed dividend under Section 902 to offset some of the U.S. tax that might be paid on that repatriation. Any other questions? Please.
Say if I have this Subpart F income, where should I report it? Like which form or which part of the form?
The reporting would be done on a Form 1120 Schedule C, which is the dividend section, and that's shown there along with the so-called 78 gross up, which is the taxes that were paid on that dividend income. On the individual, it would show up merely on the front page of the return as a dividend, or Schedule B listed out as a dividend. Thank you. Any other questions? Yes.
What if I have a foreign company and it has a loss? Can I deduct that on my tax return?
So the question was, if the foreign company has a loss, can they deduct it, assuming it's a U.S. person, on their tax return? The answer is no. Just like the benefit of a deferral, you also don't get the benefit of a loss. If a foreign entity makes a loss, that is not brought back into the U.S. unless it were a branch. So if it is a foreign company, that loss will not be able to offset the U.S. income that's reported in the United States. Okay, thank you very much.